expert in the intersection between international finance, public finance, and household finance. And today she's gonna present a paper, Sanctions and Sovereign Credit. So as usual, you have like 1 hour, and there's gonna be questions in the middle, so feel free to ask if there is any question. So thanks a lot for being here, and the floor is yours.
Thank you very much for introduction and for the invitation. It's really a pleasure to be here. So this is about the sanctions and sovereign credit. I'm interested in sovereign access to credit, especially international credit. So if you look at the Russia's 10-year bond yield, starting from Russia's invasion, so Russia officially invaded the Ukraine in 2022 February. So immediately after the invasion, we see that major Western bloc imposed very stringent sanctions on Russia immediately. So this included freeze the assets, overseas assets of Russian billionaire and even the central government, even the central banks. So, and also they have imposed stricter restrictions on importing oil from Russia. So this is a coordination among these Western blocs, including like US and EU, which are the major importers of the Russian oil. So immediately after this, you see the coordination from the major rating agencies like S&P, Fitch, Moody's. They all downgrade Russia's sovereign bond from B to C. C is essentially junk bonds. So if they are moved to junk bonds, it means a lot of investors could no longer include sovereign bond from Russia into their portfolio. So this means that their credit provision to Russia was shrink substantially. So we're interested in the implications of sanctions for credit. So in the past, there have been some papers coming out very fast talking about how Russian sanctions and sanctions more broadly affect the access of credit. And it's very clearly the sanctions would lead to a downgrade of sovereign credit rating. And this would mean that it would increase the sovereign default risk, according to the paper by Bianchi and co-authors. So they have documented on sanctions, especially hardcore sanctions, is going to affect the sovereign default risk. And if the default risk increase, naturally the borrowing cost would spike. And if the borrowing cost is spiking substantially, then the government will have to decide whether it's the optimal to borrow, right? And from the other aspect, if you're thinking about how sanctions impact on the economic fundamental, this studies by this is Russian Oleg's paper with his students, which is now under revising with submission to Review of Economic Studies. This paper is talking about how sanctions affect the economic growth and especially tightening the budget constraint for the government. So the idea is that the sanctions undermine economic growth, then tighten the government fiscal budgets. In the same manner, but from different aspects, are Lorenzoni and Warning. This is a paper in AI Insights. They were talking about the same thing on how trade sanctions affect Russia's economic fundamental, weaken the fiscal stance. So this means that if my budget is tightened, I will need to borrow more. So this creates a scenario when the central governments need to borrow, central government of the sanctioned country would have to borrow more. So they need to borrow more on one hand, but they have difficulty borrowing more because of the limited access to the sovereign credit market. And if think about this is the case, if sanctions the country have limited access to the credit while they need the money the most, this would accelerate the default probability, and that would significantly undermine fiscal sustainability. So in this way, sanctions could hurt the economy much more than they are originally expected. Originally, sanctions want to limit the trade flow, wanted to freeze the assets, but they could end up accelerated default probability, and this is even more damaging for the sanctioned economy. And so, yes.
And this paper that you were citing, Bianchi and Sousa, and under what context are they looking at?
Russia. Yeah. So these three papers I'm cited here are all looking into the Russians sanction and how it affects.
So they seem to suggest that contrary to all popular media reports, which kind of always suggest that the sanctions have largely have failed to have any bite in the Russian context because, say, Iran, India, China, or the former Soviet republics, they're still kind of big trading partners for them, and they just have moved how they think about it. That their evidence seems to suggest that's not the case.
Okay. This first paper focused more on financial sanction. These two other papers focus more on trade sanctions, although the first one also mentioned about financial sanctions. They didn't touch upon, this is a theoretical paper, so they didn't touch upon that details towards attitudes and the other things.
So these are all three are theoretical papers. There's no empirical evidence on the fire.
Yes, surprisingly, there's a little empirical studies.
Okay.
As I will show you a bunch of other papers, they are empirical, but focus on different aspects of sanctions impact. So right now, the sanction study focus on political impacts, and some of them are only economic impact, but less identification there involved. Okay, so.
And just a clarifying question, as sanction in this context, we understand just a downgrade in the.
No, it's broadly.
It's broadly.
So I would discuss all kinds of sanctions, including trade sanction, financial sanction, even arms sanctions. Differentiate it to see which one is more impactful in limiting the sovereign credit access. So broadly, all kinds of sanctions. And I think it's very important to understand sanctions effect on sovereign credit because it's important for policymakers to navigate the potential risk associated with sanctions and also about credit management. Yes.
What's sovereign credit again? Sorry.
Why sovereign credit? I have been studying sovereign credit, and if you look at the recent movement on domestic and foreign investors, you will see that they are the fastest movers. So whenever sanctions or whenever something was going on, financial institutions are usually moving faster. And as later I will show you, because of identification, this allows me to differentiate foreign and domestic investors in the credit market. But in the other markets, the differentiation of foreign and domestic investors doesn't seem to the foreign and domestic. So then, if you look at this, right? So this partially just your concerns on why the sovereign, or why focus on foreign and domestic investors. So I'm particularly interested in the foreign credit or international credit in this context, because if you look at the response after the Russian sanctions, a lot of foreign companies were either forced or voluntarily move out of Russia. Why do they do so? So if you look at the Uniqlo, right, it's really not that big deal for them, but they move out. Okay, and look at these financial institutions, even with a significant cost, they are still moving out. Okay, and these are foreign investors. If it's domestic investors, even if you move out, who cares, right? Or who, you cannot differentiate yourself from the fact that actually from Russia. Right? So you are after all being sanctioned. So regardless of how you label yourself, like right now TikTok is being attacked, but it's difficult to remove the label of being a Chinese company, despite that we're making different kind of efforts from operating in the US. Similarly here, so it should affect foreign investors more than it affects domestic investors. So if you look at this, even those who manage state, like this Austrian banks, it's not very big in the international context, but it's one of the biggest in Russia. They did cut down their operation in Russia, but they are still having some presence. So they receive a petition from various activist groups asking them to move out of Russia. And whenever they're doing business with Russia, right, helping the billionaire or something, they were criticized or even under significant pressure from EU, from the US, the public sector. So those foreign investors operating in Russia, they are having significant pressures from various government and private sectors to move out or stop doing business there. So if you were to summarize, these kind of provide anecdotal evidence that the sanctions affect the foreign investors more than the domestic investors. Okay, so one obvious is the significant pull out of multinational firms, especially international investors out of Russia. And if you look at this, right, they are very concerned that not just their business in Russia, pulling the business out, pulling the investment out is very costly on one hand, but if they don't pull it out, they will be under pressure. And they will be downgraded, for example, in the ESG rating, which is very important for the business nowadays. And they would also have this reputation issues. Oh, you are dealing with Russia, and I'm not going to do business with you. So this would put them under significant pressure. So in order to maintain their business elsewhere, they choose to pull it out instead of staying there. So this is marking a significant shift. Like in the old days, it might be safe for the investor to just keep quiet and be neutral. Now they have to do something in response to the geopolitical shifts. And if you look at the sanctions, basically it makes it difficult or make it kind of a reputationally, I wouldn't say damaging. I hope there's better words to rephrase this, to do business or to hold financial assets issued by the sanctioned countries. So if you still wanted to do business in the other broader market like the US and the EU, and you do business with Russia or the other sanctioned economy, yourself would be potentially in trouble, either imposed by the activists or by the public sectors. So they kind of make your business difficult elsewhere in their investment in the financial market. You might face the withdrawal of funding from major investors, right? So in order to do your business elsewhere, you have to do it yourself. You have to pull it out of the sanctioned economy. So this is applied on the US, on the Russia's case, but it could be generalized to a lot of other countries, especially when the sanction is very intensive. Mm-hmm. Even if you look at those relatively neutral economy, right? Even if it's a good deal, like prices drop so much, it seems to be a good business. But if I go and buy these assets, I might get myself into trouble in other countries. So this would also stop a lot of neutral buyers from the market. So then this also further limits provision of credit by these international players to the sanctioned economy. So we argue that this means that the sanctions will have greater deterrence on the foreign investors than on the domestic investors. This concerns less for the domestic investors, as we argued just now, right? So you have nowhere to go, or even if you go anywhere, you would have, be interpreted as a sanctioned economy's investors after all. So that would, but they wouldn't mean that you are not affected. It could be affected, but domestic and foreign investors could be all affected by the economic fundamentals. They are getting weaker, but this should have similar roles on both domestic and foreign investors. Here we are arguing that sanction-wise, which are taking into account its impact on economic fundamental, the sanction alone would have a more significant impact on foreign investors than domestic investors.
But maybe I've misunderstood you. Maybe it's not necessarily that they have a greater impact economically, but they create a greater incentive for foreign firms to pull out. Would that be the better thing to say?
That's what I'm trying to argue.
Okay, yeah. But yeah, I mean to say it could be that the domestic firms are as negatively impacted.
Yes.
But just that their outside options, like you said, are just not so great. So my incentive as compared to a foreign investor is just weaker to pull out.
Exactly. Okay. So I'm going to show you that in terms of the impact on economic fundamentals and how economic fundamentals affect domestic and foreign investors. They actually are very alike, but it's exactly interpretation of the sanctions and their effects on the other business. They are driving more significant impacts on the foreign investors' credit provision. Okay, so here's my research questions. So I'm going to study the impacts of sanctions on sovereign credit. And to facilitate the identification, I'm first going to compare the domestic and foreign credit in terms of their response to sanctions. So if I can prove that they have a different response and the economic fundamentals impact on the two types of investors are similar, then I can ascribe the differences to the sanctions per se. So I'm going to verify whether they do respond to sanctions differently and what's driving the difference. And then I'm going to look at what type of sanctions are particularly more damaging in terms of limiting the sovereign's access to international credit. The reason I focus on international credit is also about, when a country is in trouble, right? Its domestic economy is already shrinking. So tapping on international credit is more feasible than international credit, which is already constrained. So I'm going to explore this, and then they will help pinpoint which type of sanction, needs to be deal with carefully. And then I'm going to explore what kind of policy measures could potentially mitigate these effects.
And what if, suppose, let's say you think about domestic investors and foreign investors being kind of competing, right? Yeah. So imagine now these foreign investors, because of these sanctions, have to pull out. Can't it have like indirect positive benefits for domestic firms which are operating in the market? Because let's say, I get rid of these big multinationals who are competing with me. And so in fact, the sanctions are beneficial to domestic firms and not necessarily only, because some months back, for instance, I was reading about how when all these big MNCs like McDonald's, Starbucks, and all were pushed out of Russia, they had to leave their assets behind, and they've been quickly converted into Stars Coffee and Mec something, and they just use the same assets, and they've just been a big boom for all these businesses.
That's a very interesting aspect. The bank we pointed out, they're actually making big money out of the sanctions because others were
pushed out. Yeah.
Yes, but I haven't studied that. I need a pen. Okay. Okay.
Or maybe we can wait to see what the identification is going to come from, and then see. Yeah.
No, I think it's a very interesting question, but it's more like empirical because it all depends on the effect of how productive are these new firms, because they're going to take a bigger share of the cake. The question is, how big is going to be the cake?
So another way I take this is it's aggregate. So if one bank is benefiting from it, but the others pouring out, they will still show as shrink. So if I have the micro data, this would be a very interesting topic to explore.
One more question.
Yes.
So I know maybe I'm like getting ahead and going into policy implications, but I'm thinking about like, East Asia, Malaysia, where, we don't worry about sanctions as much. Maybe China, we do trade sanctions, but then they don't have need for, sovereign credit.
Yeah.
But how do we, maybe just a preview of like, can these findings be generalized to other types of events that produce similar effects? So let's say in the case of Argentina, which is already at a cusp of default, a hard left to turn to the hard left of the political space, right? Or let's say, the 1MDB scandal in Malaysia, which probably produces similar effect on, foreign creditors, right? So any thoughts on that?
It seems quite comparable, but I have not looked into this. I think I can do another check to see whether these major events are contaminating our results or whether they deserve another studies. And it's an interesting aspect to look into. I see many other studies that tend to focus on one event for a single country, then they would allow one to dig into that particular effects more insightfully. In this case, I'm treating kind of all sanctions in the same way, but try to do a lot of heterogeneity analysis. So I think I can have another look at that. So these are two things I need to mark down. I don't have a pen now. Okay. So after the policy analysis, I'll be moving on to see, is there anything you can do preemptively? So if you are better at something, or if you're more reserved, you have a better practice, more sustainable debt or fiscal positions, are you more likely to safeguard yourself from any potential sanction risk? So maybe Malaysia is not sanctioned by anyone else, but this is such an unpredictable world. Who knows, right? So would you, if you prepare preemptively, if you're more resilient, would you be more resilient to this type of sanction risk? So this is what I'm going to explore. So a quick answer to these questions before I proceed to the empirical analysis. Yes, we do find that the sanctions reduce the foreign credit more than the domestic credit. And indeed, we find that they reduce both. Sanctions cut the foreign credit more than domestic credit. And what type of sanctions are more damaging? Thank you so much. Sanctions, they are relatively successful, they last for long, and are very intensive. These are naturally very damaging. And also sanctions, they try to prevent the transfer of arms military equipments to the specific countries. These are called arms sanctions. It's particularly harmful for reducing credit. Think about economy of this destroy. It's very difficult one to maintain the access to credit, and also those seeking to prevent the war. The sanctions with the objective of preventing the war is also more impactful. And policies that we found to be able to mitigate the sanctions' negative effects on limiting credit access include the sterilized foreign exchange intervention. So this is supporting existing theories. I would come back to this issue later. And also we find the open capital market relatively floating, the market-based international macro policies help mitigate the negative effects. Fiscal rules also help mitigate the negative effects of sovereign credit access. And credible monetary policy, of course, help mitigate the potential negative effects of sanctions. And finally, we find some economic buffers. For example, if you have low debt burdens, you have a relatively good fiscal balance, or you have large reserve, or your terms of trade is improving despite of sanctions, then these would all help improve or mitigate the negative effects of sanctions. So how did I do this? Before moving to the data methodology, then just quickly go through the sanction effects and then skip the other related literature. Sanctions have been, the effects have been explored mainly in a political context. And so there's a lot of qualitative studies, and economic-wise, we see the economic impacts. All studies tends to focus on like FDI and the other trade volume, and these are with identifications. But recently, there are some theories that are coming up to use macro model to explain the effects of sanctions. So they do document how sanctions affect various economic outcomes, and that's through this ESG modeling, and some of them are through this economic growth, and then to the fiscal budget. So all these are well structured. And this paper by Bianchi and the others, they were documenting how sanctions increase sovereign credit. And some of the papers, some are empirical, some theoretical, was showing how this affect cross-border financial flows. And perhaps more influentially is this trend of literature on sanctions and trade. Trade is a natural connect between political economy and economics. So studies are quite well developed. Most recent papers are on these aspects. So they have talking about how sanctions affect trade. This paper on sanctions affect exchange rate is very interesting in the sense that they find different types of sanctions have different implications on exchange rate. So we're going to talk about a test how this is going to affect the sanctions effect on credit access. So these papers on trade price and is more descriptive than the analytical, and also about some limited evidence on how it affects FDI, and they conclude it doesn't affect FDI. This study's contribution is to uncover another aspect of sanctions, which is barely touched upon. So sovereign credit, nobody has talked about how it responds to sanction yet. So that's why we look at this, but mainly because I work on this area, it's easier for me. I've been trying to find out an identification strategy for sovereign credit, and sanction for me is relatively exogenous, as I will show you later. So that comes to this.
And can I, just as a curiosity, maybe, and then you can say, hey, let's talk about this later. Like here you said, this point says sanctions have little impact on FDI, for instance, right?
Mm-hmm.
When I think about it conceptually, like the arguments you make for sovereign credit seem to me to be very kind of applicable. If I was to, for instance, I could make all of these similar arguments, right? So then what would explain, and maybe that goes back to kind of Akash's question, that is this kind of case you're looking at Russia as just very special, you know?
Okay, if you look at the previous case, right, like Uniqlo pull out and multinational firms pull out of Russia, it's actually challenging this result, saying that FDI is not responding to sanctions. But if you look at this paper, these are earlier paper. So, and regardless of their identification, they were looking at the aggregate flows. So aggregate FDI, it was netted out when Russia, when others pull capital out of Russia, Russia also pull out capital from the other countries. These people that were using aggregate data without able to differentiating the directions of the FDI. Yeah. So that conclusion, I'm actually very doubtful. But I'm just trying to exhaust all this economic impact. Still, right, despite of these studies, I try to exhaust it. There are not many of them. So that also opens another type of research along this direction. So the data used is the sovereign debt data collected and compiled by IMF. So the reason I look at this is because it allows me to differentiate domestic and foreign debt. Like holders, if I'm a foreign investor, they have recorded separately from the domestic investors. So this one also allows us to differentiate the currency compositions, like whether it's in local currency or it's in foreign currency, or whether it's held by central banks or just regular banks or non-bank institutions. Okay, so this could update it to recently, the most updated in the second quarter of 2023, but unfortunately, sanction data is not that up to date. So they're only available up to 2022 and it's annual. So I carry over the annual observations. I wish to date it back to a precise date, but the data provider doesn't share that information, but this is something I really wish I can do. So this is compiled, data sets compiled by a German team. So they have been updating this from time to time, every 1 or 2 weeks. And this foreign exchange intervention is a data set compiled by IMF and some scholars from German. So they were able to find out and uncover a proxy for the hidden foreign exchange interventions. So I will be able to access both the actual intervention and the proxy or estimate intervention, and also the fiscal rules. These are some rules extracted from the constitution and laws, whether they have a specific law or constitutions to regulate the government's budgets or spending behavior, and others are generally from the Refinitiv, Denistream, and the World Bank. Okay, so if you look at the sanctions worldwide, so I'm going to look at the sanctions worldwide and then the US, which is the major imposer of sanctions. So this is the distribution of the sanctions worldwide. These countries, Russia, China, were the one that received the most sanctions by the distinct sanction case. So this distinct sanction case, like impose a sanction, right? But this sanction could last for years. So another way to measure this is I look at the number of years this country were being sanctioned. So again, these other countries, like Russia is still one of them. They are sanctioned most frequently. And surprisingly, before I look into these data sets, I know US is the biggest imposer of the sanction, but I didn't.
So these, like all parts of Western Europe are sanctioned at some point of time?
By Russia?
By Russia, Is that
Not by Russia, on Russia. So these are those being sanctioned. Sanctions.
And those are the people who sanction them?
Who are being sanctioned.
These are the people who are being sanctioned?
Yes.
And is there some parts in Southeast Asia which seem to be sanctioned? No, there's only
Indonesia and some of them, okay. I picked out all these countries that are not in my sample. So I have some broader coverage of the sanctions, but because the IMF data only cover 48 countries, so all these countries, they are not in the IMF data sets, I take it out.
And so which are the countries in your data which actually get sanctioned then? China, Russia?
All of them, almost all of them get sanctioned here and there. So if you look at this, right, a lot of them, it's just about the size, how frequent they are sanctions. So this one is more about sanction by year.
Number of years.
The number of years they are sanctions. So you see a greater coverage.
But who's sanctioning Western Europe here?
Yeah, that's what,
United States.
Okay.
US, I was so surprised, even recently, from 2004 to 2008, United States are sanctioned France and the others. I was Finland, all these countries were
For
all
what?
sanctioned for the military reasons, for the military assistance.
Okay.
So these things, to my surprise, but it does exist, especially when it's built to Sunday.
But this would include like all types of sanctions. Like, if there's a sanction on, let's say, French wine coming to the United States, that'll
Exactly, but in the case of France, right? I'm surprised the sanction is also military assistance, not on trade. Trade is earlier, like in the 1980s, 1990s. There's a lot of trade sanction going on. So I'll show you later that, for example, okay, let me finish the US sanction.
Yeah.
So out of all kinds of countries, right? 87% are actually involved with the US. Yes, please.
So Western Europe, does it have anything to do with the NATO and the Trump administration thing?
From 2004 to 2008, right? So they sanctioned France and the Finland. I was looking into the documents. It seems so, but I haven't found the solid evidence. So I have no access to this case ID. So this sanction database, they provide the case ID, but they just don't give you the content of the case ID. So I was trying to find out, but I haven't verified. There was a report that mentioned this, but if somebody here could help me confirm this, that would be great.
and just conceptually, but then like seems to suggest that the sanctions just are very different in nature, right? Like of France being sanctioned, clearly, none of these big foreign enterprises, investors are really thinking that if I go and invest in France now, that the US is really going to get after me, right? So
Exactly.
but then if you pull them together in terms of looking at the effect of sanctions,
I'm going to uncover that.
Okay.
So that will show us some pathology. But indeed, if we look into this military sanctions, exactly as you predicted, those sanctions on France, Finland, doesn't affect their access to credit. So later I will show you one of the charts, then pointing out to why these are not that effective in limiting the access. They don't mean it, right? Or the intent a prevalence of the sanction is not that huge. And also we also do a dynamic effect showing that the current sanction is actually more negative than the sanctions earlier. Okay, so yeah, again, this is by just different measures of the sanctions. So if we look at the probability of sanctions, so this is the one I was talking about. US sanctioned on the European and other countries. And so the military sanction was quite high between 2004 and 2008. That's to my surprise. But if I take this military sanction out, it doesn't actually affect my results. So this line is for the trade sanctions. Even if you check to the 1980s, these trade sanctions still dominate. So the trade sanctions is dominating this database, and it's actually escalating. And if you look at the financial sanctions, it wasn't used very frequently before, but in recent years, especially after COVID, right, more people are using financial related sanctions. Recently, when the US and EU will freeze the financial assets of this Russian, not even the central bank, but also the billionaires, this was very surprising to the markets, for the market, and it was imposed not just on Russia, but in other cases. And the trade sanction, especially with COVID, it's spiking. And all the other sanctions, they're more discretionary. For example, I forbid this diplomat to enter the other countries. I forbid that it's about diplomating, or I forbid the import of a particular prisoner to particular countries. These are too small, so they are classified to the other, but the discretionary case also increased significantly. So then I create an indicator that incorporates all kinds of sanctions without differentiating them. So I'm going to look at the overall impact of sanctions. Of course, this would lead to various concerns regarding how intensive the sanction is and how targeted the sanctions are, right? So I'm going to do my best to decompose them at a later stage. Yes.
So just clarifying question, for example, in trade sanctions,
Mhm.
what is a sanction? Like forbid trade with a specific country or forbid trade of a specific products in a specific countries? Do you,
All included.
Okay.
We have the data, they provide the data to show whether this is partial inclusion, partial exclusion, partial import or partial export.
okay.
So even with that, it doesn't affect our results.
And it's only quantity, it's not through prices, through tariffs or something
There,
like
we don't have information of
Okay.
how they imported, whether they're limiting the quantity or the price. We don't have that.
that. Okay,
But if you look at the trade sanction, which can be further decomposed into export and import, and most of the time they were imposed simultaneously. They imposed both export sanction and import sanctions. But import sanction, from the aspect like, for example, if I stop Russia from importing anything from US, that's called the import sanction. So if I stop Russia from exporting oil to the other country, it's called the export sanction. So that's different from the data definition in the data providers. So I twist it to put it this way. Initially, it was the opposite because all the sanctions are from the sanctioned country's perspective. So I do it this way to view it from the sanctions perspective to align with existing literature. So this export sanction means that I prevent Russia to export to the others. Import sanction, I prevent Russia to import something from the other countries. So these import sanctions usually actually occur very infrequently and is rarely applied in the mass market. Okay, naturally it's easy to understand, right? When you import other countries, you still want to export it to the others as a sanctioned economy. It's until recently they are willing to hurt themselves to hurt the others. Okay.
One clarifying question.
Yes.
Where the probability is the number of countries or the over 48 countries?
They are being sanctioned at the particular year.
Yeah, so
Yes.
of the 48 countries,
Yes.
almost 60% are sanctioned.
Exactly. That's to my surprise. But you see, they have different reasons to sanction people. But over time, we do see that the sanctions are more and more intensive. We don't have an exact measure of sanction, but we do observe how many countries have joined the sanctions in what kind of a spectrum. So we would use that to proxy for the intensity of the sanction. Yes, please.
Can you interpret banning exports but allowing imports as an attack on their trade balance, something like that?
Yes, I would do that very shortly. Okay. So the first, let me go through the methodology. So I'm treating sanction as relatively exogenous because it's at the sanctioned country's disposal, not at the sanctions. Yes.
Yeah, but I mean, you can imagine that a per country, let's say, deciding to invade,
Mhm.
it's hard to believe that they don't factor this in, that one of the important costs that's going to come from
Mhm.
doing this is going to be
Yes.
sanctioning by other countries, right? So the very precise time when it's going to be imposed might be exogenous, but the country should have, any forward-looking country would incorporate this into their planning, right?
I totally agree with you. So there will be anticipation effect.
Yeah.
I don't sanction it today, maybe later. But before that, you see, they might be very lucrative for them to do so. So I will show you that before the actual imposition of sanctions, there's actually little differences between domestic and foreign investors. So there are anticipation effects. I don't find evidence to support it. Those, if they're long enough. So for example, if you invest in Iran, right? Foreign investors will find a way to invest in Iran because they have a long anticipated potential sanctions and the sanctions to come. And therefore, they will already take this into account. So they're doing business until they cannot. So all these factors were already taken into account. So we try our best to control for this. Like any country-specific characteristic, they are likely to lead to the access to sovereign credit and the potential differences between foreign and domestic credit. So we try to control for that on one hand, but we're still worried that there might be anticipation effects, right? So they will do a dynamic check to see whether indeed they do anticipate it. If they do, right, let's respond to it, right? But we didn't see evidence. So I will show you in a while. So if I treat this, or if you believe me for now, and I'll prove you later, or at least, let me defend a little bit. it's so difficult for macroeconomists to find an exogenous shock. And sanctions among all is relatively exogenous. And when I tested, I was very happy to find that there was little anticipation effects. So I come back to defend this point again later. Okay, so right now, so if I treat this as exogenous for now, then the sanction is like exogenous shocks, right? They will happen in different countries at different time. So this is very similar to the staggered adoptions of shocks in the country. So what I do is that I do like very similar to difference in difference approach with continuous treatment, staggered adoption of treatment. And I run a regression to evaluate how credit respond to the sanctions, controlling for a bunch of economic fundamentals. Okay, controlling for country and time fixed effects. Okay, fine. This seems to be feasible, but you can always complain that I don't have enough control. Okay, so that's an issue. I would always subject to the omitted variable bias concerns. So the way I deal with this is that I think foreign and domestic investors are comparable in the normal times, in the sense that they are investors after all, right? They're profit seeking, they take into account whatever risk they could possibly incorporate. So in normal times, they should respond or they should operate in a similar manners, but I'm going to prove this shortly. And another thing is that, as I showed you just now, sanctions could deter foreign investors more than domestic investors. So if that's the case, I'm going to expect sanctions to have different effects on the foreign investors. So taking into this account, in every country, I have domestic investors, I have foreign investors, right? Then I compare them two with each other during a sanction relative to the normal periods. Okay, so it's like a triple difference in differences. So in this case, because each country I have two groups for comparison, I can actually control for all kinds of country variable by using country time fixed effects. Okay, so this mitigated the potential concerns on omitted variable bias. But I'm going to show you that I have some ground to do so. So once this is done, then I'm going to be very interested in beta, which is the coefficient of the interaction term. So if this beta is negative, it shows that the sanctions reduce the foreign credit more than the domestic credit. Here, foreign is a dummy indicator for credit from foreign investors. So when it's zero, it's credit from domestic investors. So if the sanction reduce credit more from the international market, this one should be more negative, right? Like it means that foreign credit should decline more than domestic credit in response to sanctions. So then this beta should be negative. So that's my expectation. Okay, so yes, please.
Do you have the source of the foreign credit? So it could be that American credit was dominant in the first period, the pre-period, and then the post-period, it could be like different types of credit.
I don't have exact number because they don't have data composition, but from a different data resources, I find that most of their foreign currency are US dollar. Yeah.
Because like other countries might go in.
Exactly, I agree. So I don't have that specific data linked to this data set, but the like sovereign level bond issues, most of them are denominated in US dollar. And also if you don't have.
Because I would say that if you show that American credit really like is the strongest decline, then you basically.
But the majority of the international funds is denominated in US dollar, although they are not necessarily from the US. Yeah. Okay. But that. Okay, I did use different dependent variables for them to be more comparable for this block. So the difference is essentially how much they have declined, like in percentage. This is like a return or growth concept. I use this debt amount, normalized by GDP, and also various estimators, and they were consistent. They point to the same direction of declining. So let me show you the baseline results. So this. First of all, I do it separately for domestic and foreign investors. So it does sanction reduce domestic credit. Sanction also reduce foreign credit. And altogether, we see that sanctions reduce foreign credit more than the domestic credit. So now let's look at the domestic variable. These are economic fundamentals that I control for. These are found to be affecting sovereign credit. And if you look at differences between the two, the coefficients in domestic and foreign, these economic fundamentals does affect credit, okay, for domestic investors and foreign investors. But if you compare difference between the two, there's little evidence showing that these economic fundamentals have differential impact on foreign and domestic credit. Okay, so then if I control for the time, like country time fixed effects, right, it would net out all these potential effects of economic fundamentals on international credit, right? Okay, so.
But if, like, again, sorry to be so picky, but like, if you just look at the size of the coefficients, I can see that you show me that statistically they are not different from zero.
Right.
But just eyeballing them, they are sharply different, right? They are 3 times the size. If you look at the budget surplus, if I look at the interest rate,
Right.
it's more than twice the size. These are substantial. I don't know how I should interpret these macro variables. So maybe because I'm not a macroeconomist, but they don't seem to be trivial differences, right? Even if you reject the statistical test, but from just a eyeballing perspective, that seems like there's noise, but they seem to behave differently to an extent, right?
Okay, that's a fair point. I would also take this into account when trying to argue the differences.
Okay.
Okay, so when it comes to importing exports,
Look at the interest rate.
yes.
It shows positive relationships. How we interpret it.
When interest rate goes up, it's more profitable, and then you're more willing to provide the credit.
So it's
So
a
in this case, for budget surplus,
price of the credit. What's the measure of the interest rate? Is there like long-term interest rates?
oh, I use policy rates.
House rate?
Yeah, by the central, set by the central bank. I didn't differentiate the long and short term. Okay, so and I proceed to put this together to compare differences between foreign and domestic investor. This is a case without using a comprehensive set of fixed effects. When I control for comprehensive fixed effects using different estimators, I find consistent results that the sanctions reduce foreign credit more than the domestic credit. So this is very consistent, using different estimators. So then finally come to a concern, are they really comparable? So I did compare domestic and foreign investors several quarters, 4 quarters before the sanctions and then 8 quarters after the sanctions. Before the sanction, you see that they're very indifferent. After the sanctions, you see that the results are declining. It shows that 1 year, 1 quarter until 8 quarter, which is 2 years after the sanction, the results become more and more negative. So this is to address the potential concern regarding the various heterogeneous Steiger dynamic treatment effects. And we propose to use this local projection differences that they claim to deal with these issues. So they remain robust. And more importantly, they justify or help justify our methodology of comparing domestic with foreign investors. Okay.
So in this chart, what are you plotting in the y-axis? What are the units?
Oh, Y is the coefficient of the beta.
Okay.
Yes, the difference between foreign and domestic investors.
Can you use the previous slide? I insist something. Can you use the previous slide?
Yes, please. This one?
Yes. Space.
Yes, I'm also very surprised when I control for this, but when I control for the time fixed effects, right? It seems a lot of them have been absorbed. Okay, so there's a different type of sanctions, trade and financials, and arms sanctions are the most powerful one. So now regarding the import and export sanctions, this is a part that I'm still, they cost me a lot of time. So
like even like when you think about different sanctions, right? Aren't they often like bundled? Like now, let's say when
exactly, they are bundled all together. I'm going to show you in a while. So just to quickly go through this import and export sanction, that these 2 different economic fundamentals, but we cannot find evidence to support that this that it's through the foreign exchange rate, through the fiscal balance, they are affecting a different response to the sanctions. So we look at this. If the exchange rate is driving this, the import and export sanction imposing simultaneously should have the lowest effects, but it's not the case. And if you look at different sanctions with different objectives, the one with the objective of preventing the war, usually when you're trying to prevent the war, right, you do more than what you can do, and you are usually bundling with a lot of others. So this one is the most impactful so far. And if you look at this by economic superpower, surprisingly, those imposed by China and Russia tends to be more impactful in limiting the credit access than those by the US. And if you look at, yes.
Because, the US has a lot more sanctions, and China and Russia doesn't have as much sanctions. So the effect
But it's about when they impose sanctions, they really sort it carefully. So if you look at the sanctions by the US and by China, by Russia and China, they're actually not as many as in Russia, as US. So US might be sanctioned for a lot of things that kind of net dollars overload effects, whereas they are really serious when imposing something, right? Okay, so the differences between emerging and advanced market is quite large for trade, significant for trade and financial, but for the others is not. Interesting case is the military sanctions, which concentrated on this EU, European countries in between 2004 and 2008. They have the opposite effect. So as you have predicted, that is more superficial and not less related to the real harm. If I look at these heterogeneous sanction effects, the first one is about whether they are imposed by multiple centers. So if a lot of countries join you to sanction a particular country, right, its impact is higher. And if a lot of you sanction a lot of countries simultaneously, the way of bypass, or instead of exporting to one country, export to the other country, there are no sanctions. The chance is lower, so it also has a greater impact. So sanctions that are successful, it means that you also have to impose stricter sanctions. It tends to be more damaging, and sanctions, they are coming up with retaliation. It makes things worse. Sanctions, they are relatively long and intensive. They also have more powerful impact. And if you look at different type of investors, many driven by the bank. Interesting. Okay, and if you look at currency denomination, it's mainly through the foreign currency, because foreign currency are mainly engaged with foreign investors, so it's easier for them to move the foreign currency denominated debt out. So then what policy response are useful? So if you look at this, so the countries, with open capital, okay, these countries with open capital market are indeed less responsive to the sanctions. And for countries pursuing pegged exchange rate, they are less responsive. Okay, countries pursuing pegged exchange rate, the foreign investors will be pulling out more aggressively. This is easy to understand in the sense that if you stick to pegged exchange rate, the currency crisis likelihood are higher, right? So that are pulling out more aggressively. And for those with monetary autonomy, it means that this country could inflate away their debt. So the foreign investors will run faster than domestic investors. And for those with inflation targeting, monetary policy are more credible, right? It's less likely for you to inflate away the debt. So the foreign investors will be less scared in response to sanctions. For the others, I think this foreign exchange intervention is very interesting. According to this theoretical paper, it says that sanctions, especially financial sanctions, is going to increase the precautionary saving in foreign currency, because you no longer have safe assets domestically, right? Local currency might depreciate, and local economy might collapse. So foreign currency is safe assets. So you have to, also will increase the demand for safe assets in terms of foreign currency denominated assets. So it's a good time, good optimal policy response for them to step in. So you buy, central banks should provide reserve and then stabilize the market. This will be an optimal strategy. So we do find that stabilized foreign exchange intervention overall is mitigating the negative effect on access to international credit. And if government central bank is selling foreign reserve either in domestic, either in spot market or derivative market, helps stabilize the currency and reduce the flight out of the foreign investors. Fiscal rules are beneficial in the sense that it reduces the impact of sanction on foreign credit, except for the expenditure, because it limits the government capacity to save the economy. Okay, there are some buffers that I will quickly go through. So in terms of current literature, I pick up this. One is the debt burden. Of course, you have low debt, better fiscal stance, you are better off, right? So it mitigates the negative effect of sanctions on the access to credit. If you have a lot of reserve, good for you, right? If you have improved terms of trade, you are more resilient to the sanctions, then all these could help you navigate the sanction risk. So, and also the sanctions effect on senders, it's actually costing for those sanctioned others. And if you look at the difference between emerging and advanced market, advanced market, they impose sanction on others, hurt it more. This is the conclusion. I hope I made it just on time. I'm done.
Oh, okay. Great. So we still have time.
Oh, okay. Okay.
No, thanks a lot for rushing a little bit so we finish the presentation. We still have like 2 minutes and we start a little bit early. So there are a couple of questions. Feel free to ask.
Yeah. So I wonder if there's your country sample is quite diverse.
Mm-hmm.
I wonder if the initial credit rating of the country actually matters. So
Okay.
sanctions on an A-rated country, say in EU, obviously wouldn't. Maybe that could be the reason why there's like near zero effects compared to Russia.
So it's the
Didn't be at first.
so you're talking the extent of credit downgrading, the driving
Yeah,
results.
and yeah, extent of credit downgrading and also where they started.
Yeah, thank you so much. This is a very interesting point. Yes, please.
So, I mean, your credit supply can be measured in both quantity and price perspectives. And I think your dependent variable is quantity based.
Yes.
So, I mean, in particular, I mean, if we think of the scenario on the like the sanctions and credit in crunch and exchange rate like depreciation and collapse of the economy, then I'm wondering whether your results are robust to the price based, you know.
I'm very interested in their aspects, but now I was constrained by the access to Bloomberg. But indeed, Austin has a paper very similarly to use the yield data to evaluate the sovereign borrowing cost.
Yeah.
So when I measure the comparable yield of borrowing costs across country, I need the tick level data so as to construct the yield, the term structure, right? So I need to make sure they're comparable in terms of terms, like how long they are to maturity and their grade. So this requires process to use a tick level yield curve and then combine it to a country level yield curve. So I don't have access to that data yet. But if you have Bloomberg data, this could be constructed with several easy steps.
So one like minor observation, your R scale was extremely high. I mean, it's around 96%.
So if I remove these fixed effects,
Oh.
they would be less.
Okay.
Yeah, they will be significantly reduced.
I think regarding the IR square, there is one
Yes.
aspect.
Mhm.
I've got a lot of experience with IR square. It raises concern from the reviewer.
Okay.
And others, is it already raised issue?
Okay.
One of the ways to
Mhm.
alleviate the concern is to show the BIF variance relations.
BR?
Correlation.
Oh, yes, yes. Okay.
BIF. So it will alleviate the concern. Because once I see a certain correlation.
Okay.
I can't issue.
Okay.
Anything else?
I just want to add, maybe in terms of your sanction type, maybe you could say like, some sanctions are consequential, especially done by the Russia and China.
Mhm.
Some are more signaling, so like being done by the US.
Yeah, so there's a lot of detection work needs to be done there. So if I have access to the specific case context, of course I can do it by myself, all right? So if I have the context, then I'll be able to do that better, like differentiate what kind of sanctions are more stringent or more symbolic. Yeah, but right now, I don't have the access to the context. Yeah, unless I do my own data collection, then.
Okay, if there is no more questions, we're gonna finish here. Thank you very much for such an interesting presentation. And there is, there's gonna be coffee outside, so